Okay, let's talk about the adjusting process here really quickly. Um, Actually, let me come back to that. I'm going to start here with the steps in the accounting process. So earlier I discussed with you the basic bookkeeping process that we have where we analyze the transactions, which is actually step one in our accounting cycle. Then those transactions are journalized, and we quickly discuss that, how we convert things into debits and credits for each particular account. From the journal, we would post into the individual ledger accounts those balances and keep a balance for each and every account we have, whether it be advertising expense or accounts payable or equipment. All of those different types of accounts would have their own balances kept in the ledger. Then accountants would prepare what's called a trial balance, and the only reason they prepare a trial balance is to make sure that the debits equal the credits. So they go back to the ledger and they pull out every account and their balance, and they add those up to make sure our debits equal our credits. That's the only reason. From there, we journalize and post adjusting entries, which is what I want to talk to you about now. So there are some transactions that have transpired that weren't captured during our earlier bookkeeping process. So they have to post those entries. Then they'll prepare an adjusted trial balance, which again is just double checking to make sure debits equal credits. It doesn't mean that some other mistakes weren't made, but it will give you initial place to stop before you go too far if the debits don't equal the credits. From that, we prepare the financial statements. And then we have what are called closing entries that need to be posted. So we need to wipe off what are called temporary accounts so they can start over for the next cycle, and I'll mention that here in just a minute. And then we prepare a post-closing trial balance again to make sure debits equal credits. So let's go back up to those adjusting entries. So there are two main types of adjusting entries. We have prepayments and accruals. I think your textbook calls the prepayments something different, but that's recategorizations or something. But that's essentially what they are, and accruals. So prepayments are for prepaid expenses. These are expenses that we've paid for in cash but not yet used, like an insurance expense. So when you buy your car insurance, you pay for it up front, and then as time goes by, it expires, it loses value. So we need to make adjustments for that. We have something called unearned revenue, which is when we're paid in advance from our customers, but we haven't yet provided the service or delivered the merchandise. So in this case, once we have provided the service or delivered the merchandise, we need to remove this liability, unearned revenue. We also have accruals, so accrued revenues and accrued expenses. Accrued revenues are revenues earned but not yet received in cash. So we may have gone out to a client's job and provided a service, but we haven't yet billed them for that, and we need to capture that. And accrued expenses, these are expenses we've incurred but not yet paid. For example, utilities. So the lights are on, you've incurred the expense, but you haven't yet received the bill. It's still to make our financial statements as accurate as possible. We want to go ahead and capture those. So let me give you an examples of a couple of them. So let's say on October 31st, an analysis of the policy reveals that $50 of insurance expires each month. So in this case, we need to reduce our prepaid insurance. Prepaid insurance is the asset, and since $50 worth of insurance has expired, we need to reduce the asset. The way we reduce an asset is with a credit. So we credit prepaid insurance $50, and we debit insurance expense $50. So once we've used that insurance, it becomes an expense to us. Expenses increase with debits. And then we would post that into the ledger. Here's a good example of what a T account looks like. The account title and then the debits and credits. So we still have a $550 balance in our prepaid insurance. Here's an example for unearned revenue. This says on October 31st, analysis reveals that of $1,200 in fees, $400 has been earned in October. So a customer paid us up front $1,200. During the month, we went ahead and performed $400 worth of service. So we want to make sure that liability, unearned revenue, even though it doesn't say payable on it, gets reduced so we don't show still owing that particular customer work. The way we reduce a liability is with a debit, so we debit unearned revenue, and we go ahead and now we get to recognize the revenue by crediting service revenue. Revenues increase with credits. Here's an accrual entry. So this is for interest. So we have a note payable, and as you all know, if you have a loan outstanding, every day that loan is outstanding, you are accruing or you have to pay more interest. So this says the portion of the interest to be accrued on a 3-month note payable is calculated to be $50. So we need to recognize that we've incurred $50 worth of expense, and that now we have a liability to pay that $50. So we debit interest expense, which is an expense. Debits increase expenses. And we also credit the interest payable, which is a liability. So now we have a liability to pay the $50 as well. Let's see if we have any others. I have one more here. This says on October 31st, accrued salaries are calculated to be $1,200. So for most of you, the end of the pay period and your pay date are not the same. Companies take a week or two to actually pay us after we've worked. Now, if the end of an accounting period occurs before we get paid, the company should technically recognize that liability since you've already worked and they owe you that money, even though they haven't yet paid you for it. So in this case, we want to recognize the salaries expense. Again, expenses increase with debit, so we'll go ahead and debit that. And we also want to recognize the liability that's been increased, which is salaries payable. That increases with a debit. With a credit. Liabilities increase with a credit. So these adjusting entries are just regular old entries that accountants have to make. They just happen to be done at the end of an accounting period. So we won't do them or worry about them until the end of a month or the end of a quarter or the end of a year. So what I showed you before then is once we do those adjusting entries, we can go ahead and prepare the financial statements. Once we prepare the financial statements, we have to do something called closing entries. And that actually allows us to start over. So our revenues for the particular year were this. I don't want to continue with that. I want to wipe that away so I can start fresh and see what my revenues are going to be next month or next quarter or next year. So we have temporary and permanent accounts. Temporary accounts are all those that relate to one accounting period. Those are our revenue and expense accounts, also our dividends account. All those are closed, and so their balances will become zero when we start the new accounting period. But our permanent accounts are balance sheet accounts, which are those asset, liability, and equity accounts. They do not close. Remember, our assets don't disappear. We still have the buildings, we still have the furniture, we still have cash in the bank from one period to the next. So those stay in place. We don't touch those. But those revenue expense accounts, income statement accounts, and our dividends do get closed and wiped out before we start the next accounting period. So hopefully that gives you an idea of what an adjusting entry is used for and what they might look like. Thank you.